Good morning, and welcome to the Energy Prospectus Group webinar hosted by ROK Resources. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Stephens, who will introduce today's speaker.
Good morning, everybody, and Merry Christmas. I hope all of you are going to be spending that day with your family someplace. Susan and I will be heading up to Dallas. We got a couple grandkids that live up in Dallas. Anyway, but thank you for joining us for this live presentation by the management team at ROK Resources. ROK is a Canadian junior in our small cap growth portfolio. It is a steady growth, light oil focused upstream oil and gas company with assets in Western Alberta and Southeast Saskatchewan. It has significant running room in two of Western Canada's top oil and gas plays. A reminder that ROK is a Canadian company, so their financial results are in Canadian dollars. And today the exchange rate is $100 US will buy you 143 Canadian dollars. Anyway, so for the 9 months ending September 30th, 2024, the company has reported net income of 4.5 million Canadian dollars, or 2 cents per share, and adjusted cash flow from operations of 16.8 million Canadian dollars, or 8 cents per share. Their 2024 drilling program is being fully funded by operating cash flow. ROK trades on the TSX Venture Exchange under the symbol ROK.V. It trades in the U.S. on the OTCQB as ROKRF. It closed at 0.155 or 15.5 cents Canadian per share yesterday, which is less than 2 times operating cash flow just in the first 9 months. So it's trading well below operating cash flow of 2 times operating cash flow, which is really crazy for a profitable company that's generating free cash flow. First Call's target price is 45 cents Canadian per share. And yesterday I brought up their year-end financials, and based on their 12/31/2023 third-party reserve report and their September 30th, 2024 balance sheet, the PV10 net asset value is about 55 cents Canadian per share. So quite a bit higher than where it's trading right now. So anyway, on today's webinar, we have 3 of the founders of ROK Resources. They were previously working together as a management team at Villanova 4 Oil Corp, which was sold in 2018, 6 years ago. So today we have Cam Taylor, the company's chairman and CEO, Bryden Wright, president and chief operating officer, and Jared Lokomsky, I hope that's pronounced right, senior VP, land and business development. So Cam Taylor is the former president and CEO of Villanova 4 Oil Corp. He also had Villanova Oil Corp and Villanova Resources. He is a geoscientist with over 30 years experience in oil and gas exploration and production. Bryden Wright is the former VP of engineering at Villanova 4 Oil Corp. He has over 14 years of experience in the Williston Basin oil exploration and production business, specifically in Southeast Saskatchewan, conventional and unconventional oil plays. He holds a bachelor's degree in petroleum systems engineering, and he is a registered professional engineer in Canada. Jared is a former vice president of land for Villanova 4 Oil Corp. So prior to joining Villanova, he was employed by Comex Credit Union from 2000 to 2007, where he managed a book of business in his role as commercial account manager. So now I will turn the controls over to Bryden Wright for an update on ROK Resources. So it's all yours, Bryden.
Thanks, Dan. Thanks for having us, guys. Yeah, well, we're happy to be back. I'm going to pass it over. Cam's going to do the first few slides, and then I'll take it back in a few minutes.
Thanks, Bryden. Yeah, our group has been working together for the past 16 years as a team, complement each other really well. Variety of skill sets in geoscience, engineering, and business and land negotiation. I think the key thing for us, and maybe next slide, Bryden, is the history we had in our experiences managing, building and selling private corporations. Over the history of those companies, through both some financial downturns and some boom times, we were able to build and sell companies and get a good return to our shareholders. I think the exact same disciplines that we brought to the table for those 4 companies we're applying to ROK, although this is a larger platform and a different environment. The M&A side of the business isn't moving as quickly as it did back then, but certainly that experience set us up both for some careful fiscal management and also doing M&A and growing with the drill bit. I think next slide. Just a quick snapshot of the company. Our basic shares outstanding, 218 million. We also have a set of warrants that are set to expire in March 4th, 113 million of those. And currently sitting with a enterprise value of 51.9 million, with our estimated current debt at 12.6, which would be the exit debt for the company this year. Really important to mention, from my point of view, the management and board hold 17% of the basic shares in this company. So we're highly aligned with our investors in terms of both playing defense with the balance sheet and being careful not to take any unnecessary risks, but also trying to grow wealth here for ourselves and our shareholders. So I think the alignment's really strong in the management and board on this company.
And just to interrupt you, has there not been some more insider buying as of late?
Yeah, there has been. Yeah, we had a set of options that came due, and I exercised those. Brian and Jared did as well, and then I purchased some shares in addition to that. So there has been some. So the highlights for 2024: 4,000 barrels a day production. We've chosen, given the gas prices in the Canadian basin here were the lowest we've seen in 30 years, which took away some of the extra free cash flow that we're used to having out of the gas side of our business. And we chose to run a maintenance capital program this year, about 20 million, and reduce our debt. We reduced it from 18 down to 12. Again, just trying to be careful with the balance sheet and get our debt reduced so that we increase our flexibility going forward here as we watch what happens, in particular with gas prices into 2025. But Brian, maybe I'll hand it over to you to just walk through some of the details of that program.
Sounds good. Thanks, Cam. So to Cam's earlier point, 2024, the first half of 2024 was focused primarily on reducing our debt. So we exited 2023 at over 4,500 barrels a day, and for the first half of 2024, we had a very muted drill program. We spent about $4 million drilling wells in the first half of 2024, focused on reducing our debt. And then as we moved into the second half of 2024, we began drilling. In total, we only drilled 7 wells this year. We were able to maintain 4,000 barrels a day of production with just 7 locations. So we're seeing our corporate decline rate reduce over this period, which is great. Of those 7 wells, we focused on Midale and Frobisher in Southeast Saskatchewan, which I'll get into in the following slides. But that's been the focus of our drill program over the last couple of years. And you'll see why as far as the economics go. We expect to spend a total of $20 million this year, of which 11.5 million are focused on drilling, completing, and equipping wells. So just over half of those dollars are dedicated to drilling. We did have a little bit of facility work included in that, some land budget. We spent about $2 million on ARO, so asset retirement obligations, abandoning wells and reclaiming leases. So as far as the maintenance budget goes, we're able to keep this asset base flat with, $15 to $20 million annually. One thing to stress and focus on is the debt reduction. So we've been able to reduce our debt by over 30% year over year, while maintaining production. So again, I think it speaks to the kind of the quality of the asset base, and our ability to to keep things running at a reasonable capital investment annually. So as you look at the results well by well, so again, we didn't start drilling till June. We've drilled 7 operated locations, 6 of which are in the Frobisher, in southeast Saskatchewan, 1 in the Midale. On this graph, you'll see the dark blue line is our internal type curve that we run, which is slightly lower than our reserve estimated type curve. The black line is our average performance to date on these 7 locations. So we're exceeding our type curve by about 20%. We have 2 wells that have just come on production. We have less than 30 days. You can see in the brown kind of location here, and then this lighter blue line, which is trending up over the type curve and over the average. So we had 2 wells that we drilled earlier in the year that were disappointing wells, and then since then we've drilled 5 locations that have all come on well in excess of our type curve. Of these 7 wells, 4 of them were booked locations, 3 of them were unbooked. So I'll speak to drilling inventory in a few slides here, but overall, very happy with the results. We didn't, as we look to grow this year in light of pricing, and our focus has been debt reduction. So in the wells that we've drilled and the areas that we're focusing on, we're seeing IP30s in excess of 150 barrels a day, versus a type curve of about 115, 120. So we're happy with those results, and as we push into next year, we'll be looking to build on that, and I'll speak to the areas here that we're focused in. So here's a kind of a zoomed out snapshot of southeast Saskatchewan. So each of these blue boxes is a square mile. So we own over 280,000 gross acres of land in southeast Saskatchewan and over 120,000 net acres of land. We have operated in this area for 20 years together. We have built all the 4 previous iterations of companies were all in this area, so we know it very, very well. We have 2 or 3 areas that we're really focused on right now. The Steelman area, which you'll see on the next map, I have it labeled, is kind of right to the map. And then this, the bigger, more consolidated land base here is a focus of ours going forward, both in the Frobisher and the Midale. One exciting trend that's starting to occur in southeast Saskatchewan is multilateral drilling. It's not a new technology, but in terms of the application here, we're seeing 4 to 10 leg wells being drilled in Saskatchewan. One of which is targeting a dolomitic member of the Frobisher formation, and the other where we see potential on our land base is this dolomitic Marley zone in the Midale. So we have a lot of land kind of in this core area with this dolomitic member in both the Frobisher and the Midale that we see as massive unbooked potential as we move forward. There's these companies drilling, like I said, these multi-lat wells, and it's quite early. They've been doing it for the last 3 or 4 months, but as we move into 2025, we do see the potential to begin drilling some of these locations up. And again, all of that is unbooked on our current land base. So an exciting opportunity as we move forward into 25. So speaking specifically now to the areas, so success drilling in the Frobisher. So 2 of those locations that I previously had noted were in this area, one of which was unbooked, and it has opened up a section of land that was previously undeveloped. The Pinto box, as well as Oxbow and Glen Ewan, those would be the other areas of focus for us. We have the bulk of our locations are booked in these areas. We have a total of 117 booked locations at year end last year, with a significant potential number of unbooked locations to come. As we work through 2025, we won't see those on our year end reserve report this year. Again, we drilled 7 locations, so it was a more of a maintenance budget this year, but moving into next year, we do see, hopefully we'll see some oil price and gas price, momentum, and we can go out and deploy some more capital on drilling. But we do see, a lot of upside and a lot of room for growth here on our inventory. So you've heard me mention the Frobisher. Some of you may be familiar with it. It's one of the top formations and plays in North America. You can drill these wells. So this slide, we have these wells at 1.3 million. This would be a dual leg well. We've been able to bring that down closer to 1.2 million capital cost. These are conventional open hole wells, no frac required. We're seeing IRRs well above 100%, payout in less than a year, and that's at $70 WTI. So the economics here are phenomenal. As we move into $80 and up on WTI, we do see a significant increase in IRR, NPV, and obviously our payout is reduced. We've had wells pay out in 4 to 5 months in this area, in this play. Some wells come on in excess of 300 barrels a day, and so we've drilled a couple of those. I think we had the best well, or one of the top 3 wells in Saskatchewan in July of this year. And so again, it's a little bit more geologically complex. It's not a resource play, so it's it takes expertise in terms of finding these smaller pools. But we've been able to do that over the course of our careers, and we'll continue to focus on the Frobisher as one of the important plays in ROK. So coupling to that is the Midale. So the Midale is the Frobisher. Historically was completed open hole and vertically. About 10 years ago, there was a subset of the areas that the companies began fracking, and we were one of them in the Villanovas. And so for about 10 years, this was then developed with fracs. And now we've kind of gone back into the multi-lat, where we look to develop this with 2, 3, 4 leg wells. And so the economics you see on this slide, 1.9 million, this is with a frac. We just drilled our second well unfracked, just open hole multi-lat. We're able to do that for 1.5 million. So we do reduce the capital cost by about 20% by going with the multi-lat open hole design. And we're seeing similar results in terms of IP rates. And we'll see EURs once we get through reserve time. But overall, the Midale is a longer life, larger EUR play. It's been water flood for about 50 to 60 years in Saskatchewan. So we're actually we have 2 projects, 5 for water flood, to convert some existing fields to water flood, which will help with our decline rates, help with our production curves, and overall our operating costs as well. So the Midale and the Frobisher together has been a really good duo of resources that we've had over the course of our careers.
What's your current decline rate corporately?
At the end of last year, we were about 27% corporately. We have seen that come down, a little bit. We're working through our reserves right now. We have had 3 wells come on production within the last month. So a little bit tough to say exactly what that is right now, but I would say it's probably in the 25% range is my guess.
Okay, thank you.
So overall, we're extremely excited and bullish about our asset base. I didn't speak to our Alberta assets as much. We do have, in addition to our Saskatchewan assets, we have about 1,200 barrels a day in Alberta, and it's not a focus right now in terms of exploration and development. However, it's about a 12 to 15% decline, 70% gas assets. So as we see, gas prices increase, into next year, as kind of LNG takeaway increases and gas demand increases in Canada, we will see the value of that asset increase. But for now, our focus has been on Saskatchewan, and I think it's a testament to the type of plays we have, in terms of what the capital investment is required on a well by well basis. We're sub $1.5 million per well, and we're seeing anywhere from 100 to 300 barrels a day IP30s on these wells. So as prices kind of stay in this 70 to $80 range. Our focus will continue to be Saskatchewan. If we see an uptick in pricing, specifically on gas, we may look to deploy some capital in Alberta. Potential free cash flow generation, again, as we drill these wells and we have quick payouts and an ability to either put those dollars back into the ground or use them for other purposes, we can create some significant free cash flow with this asset, especially as prices move over the next year. Proven management team. So, Cam spoke to this. We've done this many times before. Obviously, we're in the public space today, so a little bit more scrutiny. And obviously, we see our share price over the past year, which has been challenging. But as far as what we can control as a management team, we're very happy with where we sit today. We've deleveraged. We're in a position, for growth as oil prices continue to climb, right, or begin to climb, hopefully. And gas is only a bonus on our asset base. So, we'll continue to be prudent with our balance sheet and with our capital allocation. And, as far as our asset base goes and, potential for acquisition and for M&A in a lower price environment, I think ROK is positioned quite well. We have long-term development upside. So again, I think the water flood piece in Saskatchewan helps with that, extending the life of wells, extending the life of fields. Our inventory base, we believe, will continue to increase as these plays are developed. So, we're happy about where our asset sits today. And, over the first half of 2025, we'll look to continue to reduce our debt. We do have, some moderate capital, plans for the first half of 25, but the focus will be to continue to pay down debt and hopefully provide some flexibility to ourselves, from a balance sheet perspective, both on an M&A side and, what we do with our capital, and our free cash. So I'll speak quickly. So that's kind of a, summary of our oil and gas assets and where we sit today. The lithium assets. So we had, I won't go back into too much history, but we had acquired a 25% interest in a lithium resource. We were the technical team. Last year, we were able to do a share exchange agreement with EMP Metals. So we now own an equity position in a public company called EMP Metals. And so that's held under the ROK umbrella. There's an escrow on those shares, so there'll be no sale of those shares. In the meantime, we're acting as the technical advisors, technical team for this project. It's in right around our oil and gas assets. We know it very, very well. We've continued to assist the EMP team, and this project is moving forward kind of in parallel to our oil and gas assets. We released a PEA, preliminary economic assessment, last year, where we had previously drilled the highest concentration lithium well ever recorded in Canada at 259 milligrams per liter. We drilled a follow-up well that tested very high as well, I think in the 230 range. And we subsequently, after drilling those wells, released a PEA that had a 55% IRR and $1.5 billion NPV8. And so that is for the project as a whole. So significant value proposition with these lithium assets. Right now, to date, we've done a pilot with Coke Technologies, obviously out of the US, multinational company. We're continuing to work with a group called Saltworks in Canada on the refining side. We've drilled a horizontal well for the lithium production, the first horizontal well ever drilled. Those results will be released sometime in the new year. But so far, this project is moving forward. The DLE, which is the direct lithium extraction technology, is kind of the last piece to the puzzle, and whether that can be put in at scale and perform at scale is still the big question mark. And we're starting to see that happening with the Standard Lithiums in the SMAC over in Arkansas and other company in Saskatchewan that are moving down a path similar to us. But as far as the Canadian lithium resources go, ours would be right at the top of the list in terms of value, potential value, impurities, and overall quality of the brine. And then quickly, if this is again from the PEA, we had the highest lithium, compared to any of the peers in Canada. And that's an average. So that's an average over the life. When you look at specifically the best members, we're well above 200 milligrams per liter. We have some of the lowest operating costs. We believe we are the lowest. You know, it shows a peer here that is lower, but we believe kind of over the last year doing more research and understanding what our asset looks like, that we would be the lowest in Canada. And then, you know, as far as the pre-tax NPV and IRR, we're right near the top of the list. So, you know, the project itself is, you know, potentially could be phenomenal. I think there's a few things that we need to achieve over the next year, additional testing, some reservoir studies, etc. But overall, you know, ROK has now removed ourselves from, you know, having to deploy capital on this. So our company is focused 100% on oil and gas, but we are assisting on the technical side of things with EMP Metals to push this forward, because we own, I believe, about 17% of their company now as a whole. So.
Yeah, I'll just insert myself here. 17% of EMP Metals, which also trades on the public market. Their market cap today is roughly 44 million, so it's worth roughly 3 to 4 cents a share to ROK today.
Thanks, Jared. Just some analyst coverage. So we do have 4 analysts currently covering us, all of which are located in Canada and Calgary. And that is it.
All right, good job. Okay, I've got a couple questions, and these really are to help me do my modeling on the company. What is your current production mix?
Yeah,
oil, gas, NGLs, right?
So we're about 4,100 BOEs a day today. Okay. And Saskatchewan is roughly 3,000 of that, just under 80% liquids, or I would just say 80% liquids, you know, as an estimate. We did bring on some new wells, which are quite oily. As far as liquids goes, I'm gonna guess, I don't know that number off the top of my head, but you know, we're probably in that maybe 300 barrels a day of that is liquids.
Okay.
And then in Alberta, we're, you know, the other 1,100 BOEs a day, of which would be almost 70% gas.
Oh, I noticed in your third quarter report that you had about 300 BOE per day of the stuff in Alberta shut in because of low gas prices. Are those wells coming back online with higher gas prices?
Yeah, so they came back online in, I want to say, right at the end of October, 1st of November. We've had some shut back in momentarily. We're trying to get those back on. It's a third-party operator
right.
that controls the gas plant, and so they've, I believe, in light of just higher gas prices, they've had some additional volumes come on, so they're kind of managing those volumes. But yes, the short answer is they all came back on in early November, and we've had, you know, a subset of that back offline for the last couple of weeks. Hopeful to get that back on at the end of the month.
Okay, what's the AECO gas price right now?
It's around $2 an MCF.
Still $2, okay.
Yeah.
Now, you know, we had in play oil down here, and then Hemisphere too, and they talked about how when that LNG export facility on the west coast of Canada comes online, they expect that to be kind of a game changer, give you more access to the market. Yeah,
I mean, we're starting to see, you know, if you look at futures on AECO out into late 2025, Q4 2025, and through, you know, early 2026, you do see demand increasing and those future prices increasing to over $3. Mm-hmm. So that is kind of what we've heard. One of our board members is an oil and gas marketer, and he's, you know, he believes in that as well. So I think the demand significantly increases as that LNG takeaway, you know, starts to actually happen. So, you know, we are cautiously optimistic that we'll start to see gas prices. You know, if we have an extremely cold winter, that always helps up here. And but that is the, you know, I guess the forecast that we are seeing, and that we do tend to agree with, that as we push into late 2025, we'll start to see a little bit better, more attractive pricing.
Well, we have a new president that's very bullish on LNG. I'll tell you that. He's going to fast track a lot of these new LNG export facilities. And I heard the reason is, you know, the U.S. has a bad trade imbalance, And one of the quickest ways to improve our balance of trade is to jack up LNG exports as fast as we can. So that should help, and that should help all North American gas producers. I think it's a real plus. Let's see, production. Do you think the 2025 drilling program is going to be about the same, 7 to 10 wells or something, just kind of maintenance? And are you still going to be focused on oil-prone areas, or?
Yeah, I mean, the first half of 2025 will be subdued again. I think, if it really is price dependent. If we're seeing oil in the $70 range or sub $70, I think, we'd rather wait and bring on these really attractive high IP producers in a higher price, world where we're not, producing 300 barrels a day in a well at $68. I think, we could see some growth into the second half of 2025 for sure. We want to get our debt reduced to a point where we have a little bit more flexibility. So if we can get into that, $6 to $9 million of net debt, it does open up other opportunities for us, both from a share buyback perspective or a, dividend type model. Not to say that we would go to a dividend model by any means, but it does just give us flexibility. So our focus over the first half will be to reduce our debt, drill a couple of wells, and then just, evaluate where things look from an oil price perspective and a balance sheet perspective into June, July.
Yeah. Was your credit facility renewed at the end of November?
Yes.
Okay. And at the same level?
Yes.
Okay. And you still got 11 or 12 million undrawn on that, right?
Correct.
Okay. Do you have a slide on your hedges in here?
Oh, we do. Yeah.
Yeah. Let me show that. I know you're required by your credit facility to hedge quite a bit.
Yeah. So you can see here, we have about 1,500 barrels a day, just under $100 Canadian. So that would basically correspond to that, $70 WTI-ish number.
Yeah. So you're going to get a cash settlement paid to you on that one, right? For sure. I would think.
Yeah, a little bit. Like I think, the bulk of our hedges, and I don't know if Cam, if you know this, but when we looked at this a few weeks ago, our gas hedges were quite a bit in the money. And so we had $4 or $5 million of value in our hedge book at that time. So basically we have 12-month rolling requirement with our lenders to hedge 75% of our PDP. So that PDP though was calculated back in March. So as you look now, so we're sitting at 1,500 barrels a day right now, where we're at well over 2,500 barrels a day of oil production. So we're probably sitting in that 65% of production is hedged right now on the oil side, not 75. That makes sense.
Yes. Okay.
Yeah. Anyways, this is our current hedge book, and we roll on every month, 12 months out.
Yeah, in my forecast models, I try to estimate, kind of what your realized price, including your cash settlements on the hedges are. And over time, I'm getting better at it.
Yeah, we adjusted our model to do the same thing. Exactly.
Yeah. And for all of our listeners, the Canadian companies have the same accounting rules as we do in the U.S., where they have to mark their hedges every quarter. And so those can be kind of distortive, but when you look at, that's why I focus on operating cash flow versus reported net income, because reported net income can flop all over the place with these mark-to-market adjustment on the hedges.
Right.
Yeah. So, and they're trading, I mean, this company's trading at less than 2 times operating cash flow, which is crazy for any company that's, net income positive, free cash flow positive, balance sheet's in good shape. They've paid off a ton of debt, and they got a lot of running room, so it should be going for more of that. Hey, let me ask you, how are you going to account for your equity stake in EMP? Is that mark to market each quarter?
Yeah, that's right.
I believe so. Yeah.
Okay. Yeah, because you got a big enough stake in that thing. Now you can't sell it right now, right? You're restricted.
No, I think we have another 15 or 16 months of escrow.
Okay. But you don't have any intent. I mean, if they prove this up, like you said, this thing could be worth a lot. I mean, you're looking at $1 billion potential here, I guess.
I think our intention here with lithium is to just keep working it forward. There's a number of larger players active in the Smackover that have interest in this part of the Canadian basin. And we'll just keep doing all of the groundwork. We're getting a feed study ready. But this isn't something we see a short-term exit from or ability to monetize. So it's really just laying groundwork for eventually down the road here, seeing some kind of a large scale exit that'll put some cash into the company and then we can decide what to do with it when the time comes. It's just not, we don't have a clear timeline on that. It's moving forward and lots of players in the game right now that we stay actively engaged with. So.
Yeah, well, and several companies say they're really close to proving up the direct lithium extraction (DLE). Volt Lithium did a luncheon for us the other day, and they act like they're very close to it. So we'll see. I don't know. Let me get to some of the questions that are in the chat box. See, somebody asked, would you consider going debt free and then starting a variable dividend, or you just stay leveraged and focus on faster growth and exploration instead?
Yeah, I think both of those are on the table, and it's very dependent on where we see the price points and how we're trading. So,
Right.
I think Bryden's mentioned it several times. Our goal here is to just give ourselves flexibility on all of those options, and then when we sit down in May, June, we'll take a look at where all of those pieces land, and we're constantly looking at M&A and that can include our own shares if we feel that's the best move. But it's about getting ourselves into position to have all of those things on the table and make good choices from there.
Yeah. It's just so hard. Like right now, we follow some companies, they were using a combination of debt and equity to, make acquisitions. But the problem is when your stock price is so low, that's kind of takes that off the table due to acquisitions with stock. But anyway, a lot of interesting. You're not the only company out there that's trading like below any reasonable value, because I don't see any reason why a company should be trading below PV10 of their proven reserves. And I think Hemisphere is. I think InPlay is. I mean, they're all. It's really something on the Canadian juniors.
Yeah, well, we're hopeful that we have a government change next year that could, prove to be a catalyst. We've seen the finance minister resign in the last week, and I think the majority of the country is moving to support the conservative side. So we'll see.
Yeah. So John asks, he says, at the moment, the bid-ask spread on ROK RF is 36%. I looked at this morning. I didn't think it looked that wide, but I'll kind of answer this question. When you buy stock in the U.S. On the OTC board, you always make a limit order. Always put in a limit order. And if you're just a little bit above the bid, it will usually get filled pretty quickly. So that's just how you got to buy it. But when you buy it on the U.S. market, don't just put in an at the market. I don't think I bought some recently, and I don't even think they allow you to do a market order. I think you have to put in a limit order on those anyway. Okay, on the warrants. How many of the warrants are in the money? I don't think many of them are they?
No, the warrants at 25 cents are the warrants that are sort of in play right now, and so they're well out of the money right now.
Okay, and when do they expire?
March 4th of next year.
Of 2025.
Yeah.
So your fully diluted share count could go like way down then after that. Yeah.
Correct. Yeah, about 113 million.
Yeah. See, in my modeling and on my valuations, I don't really include things like warrants, things that might not happen, especially if they're out of the money warrants. because they're not going to exercise them if they're not out of the money. They'll just go buy the stock if it's cheaper. So, you know, I just ask the question, why don't you use fully diluted? Well, you got to say, if you are going to value a company based on fully diluted, then you have to put all that cash in. I mean, for you guys, it'd be great if they did exercising, because you get that cash and you could use that cash to totally pay off all your debt, right?
That's right.
So that'd be great, and then you'd have it. So anyway, just remember, when you value a company, just make sure know when they expire, what's the odds of them being exercised, and on this case it's pretty small in the near term. And their question, will you grow through the drill bit only, or you would consider further acquisitions, and would they be oil focused or gas focused acquisitions?
Yeah, we're actively engaged in evaluations of small, tuck-in acquisitions. We worked pretty hard on a couple over the last quarter. We were at the table, weren't able to acquire them, but we're continuing to do that. I would say they're all strategic in terms of geographically where they are located, and I would say oil is probably. That being said, if there's a gas or a liquid rich gas asset that makes sense, that's offsetting some of our existing infrastructure, then we would look at that as well. But we're more of an oily focused company overall.
Yeah, and I did notice in my forecast you're getting really good prices on your NGLs, right? Like $40.
Yeah, I'd say anywhere from $40 to $50. Yeah,
that's a pretty good price. I've got some of them. That they're selling their NGLs in the Permian for like single digit prices. Crazy.
Wow.
Anyway, growth. Let's see. What price of oil, WTI, do you need to drill more wells or get out of maintenance mode? And and he asked about hedges. We've already looked at the hedges.
Yeah, I think if you look at our asset base, it's kind of like a tiered type approach. We have a lot of oil plays that make money at $50, $55, $60, like the Frobisher and conventional Midale. I think it's really a decision at what point do we want to, and I mentioned this earlier, at what point do we want to allocate capital to produce flush barrels into a lower price environment. And so for us, at $75 to $80, I think things become a little bit more attractive. But more dollars, I think it's more of a stepwise thing and not a binary, 10 million or 40 million type of decision. So, I think if oil prices are to trend up over $80, you'd see us allocating more capital to drilling and reserve growth. And if it's, 65, I think it's a little bit less, right? So, yeah.
Well, I think there's definitely upside to the oil price. I did a podcast the other day, and I continue to believe that the right price for WTI is in the $75 to $80 based on, inventories. I mean, global inventories are very low. They're at the bottom of the 5-year average. Some are, refined products and stuff. Some of them are below the 5-year average for where inventory should be this time of year. So there's a lot of noise, and I truly believe there's market forces, quote forces, whatever they're doing, to try to keep oil prices low, because it's the only way they can keep inflation low. And those forces want the Fed to keep lowering interest rates. That's what they really crave, the Fed. And I guess today they're going to increase them by another quarter point or something, which would help. And then you got, nobody really knows for sure, what is Trump going to do? I'm 99% sure he's going to enforce the sanctions against Iran and probably against Venezuela. There's talk about, him wanting to refill the Strategic Petroleum Reserve, but, those don't agree with when he wants to keep, gasoline prices low. So, what's he really going to do? You can't do both. And, but we'll see. We'll see.
Well, one thing too, Dan, I just wanted to note, like obviously we operate in Canada, and all of our, capital going out is in Canadian dollars. We sell our oil to you guys in American dollars. So the FX rate at sub 70 cents right now is significant. So, right now, even at $70 WTI, we're getting a 40% premium or whatever on that when we sell our oil. So, it does help in terms of oil price, you know, when FX is where it sits
Yep.
today, and I don't see the Canadian dollar getting any better in the near term, so that does help us as well.
Yeah. Of course, I don't know what keeps the U.S. dollar strong. How can
Yeah,
you be more? How can you be more in debt than we are? I guess we're just the only. I always say we're the cleanest dirty shirt in the laundry.
Yeah,
Because
yeah,
where else
exactly.
are you going to go? Not to
Yeah.
Germany or something, right? And I'm not going to.
Just that last question about sort of when we drill to grow. This last drilling program that was maintenance, we included, 3 unbooked, maybe it was 4 unbooked. We're maintaining, we're constantly drilling up new plays that we think we can bring additional locations to the table. 2025, this new play that Whitecap's been leading on, but a few other players are drilling the multi-legs in the State A, adds a lot of potential. All of this is sitting right underneath our existing oil facilities and pipelines. So it's half cycle economics for us there. And you'll see probably early in the drill program, you'll see us testing that play on our own land, directly offsetting where the Whitecap's drilling and other players. And then we'll do the same on our Midale. So we'll set ourselves up with some strategic drills that we've already done some multi-legs in the Midale here that appear to be going well. So we'll continue to set the stage for that so that if we see what we like and the oil price is appealing and we've got our debt down where we want it, then we can take off and drill a bunch of wells very quickly because facilities are in place, pipelines are in place, debt's where we want it, new play to go running with, and in addition to our existing Frobisher and Midale. So strategically, we'll be set up so that late in 2025, if we see that favorable pricing, we can go on a drilling run and move the production from there. But for this past year and the initial part of 2025, it's going to be very strategic what we drill and how we set ourselves up.
Yeah. Does your acreage area in Saskatchewan, is most of that held by production already?
Yeah.
Okay. And then it has year-round access, correct?
Yeah, with the exception of like March 15th to early May, we have road bans for spring melt. So, we're able to produce all that time, but moving drill rigs around, there's a month and a half to 2 months that we don't move rigs.
Yeah. Well, when I worked at Hess, we had all that stuff up in the Bakken, and we pretty much shut down the drilling program mid-December and didn't even restart it up until June, like every year. So, yeah, it's just so much more expensive to try to deal with that weather problem. Damien asked, have you done pad drilling with multiple wells to reduce surface leasing costs? Also, are you able to do more clean up of old wells and surface leases to reduce per unit break-even costs to be more profitable in lower price times?
Yeah, on pad drilling, that's being done. That's been done. It really just depends on the play and the surface access and what type of acreage we have. So there's multiple sites where we'll drill 2 or 3 locations off of a pad, build a battery right on that same pad. So absolutely. As far as re-entries go, I think it's a site-by-site, play-by-play decision. So sometimes, for instance, if we have Cam was speaking to the Midale Marley. If we had a wellbore that was drilled into a Marley zone, we could go re-enter that and kick off potentially and drill multiple legs off of an existing wellbore. So that's always decisions that we make. We do have quite a bit of wellbores in Saskatchewan. Part of our focus is abandonment and reclamation to reduce those obligations, but also to reduce operating costs. But there is good value of having all that infrastructure as well, because everything's half cycle and you do have wellbores for disposal, you do have wellbores for re-entries and things like that. So yeah, to answer his question, it's all evaluated and we definitely consider all of those opportunities.
Yeah, and you don't have some big leasing program going out getting undeveloped acreage because you got a lot of acreage, right?
Yeah, I think we only spent in 2024, I think we spent about $1 million on land, which, if you compare that to our previous companies that we built at the drill bit, meaning we would go and acquire all of our undeveloped acreage and grow the company that way. We would have spent, $10 million a year sometimes on land. So
Yeah.
it,
So what you're looking at is really buying existing production. Like somebody just has to sell, like,
I
they
think
don't have a-
both, like, I definitely think buying upside locations is important, but,
Yes.
buying PDP, everything's trading at PDP right now. So if you can
Yeah.
buy something for sub PDP with some upside inventory, then that's great, right? And especially if it's in our operating area, that's kind of what we're
Yeah.
focused on.
See, that's what gets me. I mean, when I was at Hess for the last 6 or 7 years, I had a team looking for, acquisitions all the time. And man, the amount of, how you can buy stuff at PDP with a bunch of, proven locations, drilling inventory. I just can't believe there's not more aggressive acquisitions going on by some of the big players, but I don't know, who knows? Interesting times, that's for sure.
I think it'll come.
Yeah. Okay. Let's see. Oh, I said, okay, at 9/30/2024, the book value of ROK's common stock, fully diluted, was about 47 cents Canadian per share. That's book value. What really, do you see any justification for the stock trading at such a large discount to book value? I just can't see it.
It's to me, it's, it's to your point earlier, it's not about the individual stock. I think this sector has just gone to, the people that are out there buying stock right now are buying CNRL and Tourmaline and the bigger corps. So, yeah, there's nothing that we see structurally within the company that justifies that. So it's just part of this cycle that we have to move ourselves through and get to the other side of.
Yeah, and the smaller companies are always the last to move. I mean, when you see some money moving into the sector, and I gotta believe it's going to happen. These stocks are just too cheap. I mean, especially I follow some that are paying dividends, 8 or 9% dividend yield, and they got a ton of growth potential too, and they're still trading at very low prices. So really a crazy time.
The entire year, Dan, was a difficult one for Canadian, especially small mid-cap oil and gas. Obviously our government hasn't helped that. I think that will change next year. So that's a catalyst for us and other Canadian companies. We had some significant tax loss selling over the last 2 months. We have seen kind of one larger shareholder continue to sell, which is, I think moved about 20 to 25% just since October, our share price, and that for the most part has been tax loss selling from one large shareholder and whoever else. But I think moving into early 2025, I think there's a lot of potential and a lot of room for that stock to move back upwards. So
yeah, I had a discussion with one of our members who's an economist that lives down in Brazil, and he did a pretty exhaustive study that shows that the stocks that are down year to date are the ones that have sold off the most. So it's tax loss selling. And, so some of these guys managing money, they probably have realized some big capital gains on some of these tech stocks. And so they're looking for anything they can do to offset those capital gains taxes. I think that's a big deal. And you know what will happen, guys? The funds that have sold these for that purpose, they'll go right back in and buy the same shares back at the first of the year. So as long as they can get past the 45-day rule or something. But anyway, so what do you see what do you think is your greatest risk of you succeeding in growing into the late 2020s? Would you just say oil and gas prices, I guess, right?
Yeah, the natural gas price one's quite important for us. Like we lost probably $7 million, 6 to 7 of revenue off the top on that. So that's a really important chunk of the free cash flow that's available to grow. Part of the question with our drilling decisions, oil price is part of it, but natural gas creates a lot of the free cash flow. Having the lowest price in 30 years last year, we had a lot of our Saskatchewan associated gas that was well underwater, so we're losing money on it. So,
right.
I would say that gas price is a really big part of how much free cash flow we have to work with. If that comes back into a normal range again and we start getting those dollars back in our hands, and that free cash flow available to do some drilling with, that's a really key piece of this. We can make a lot of money off of even at $70 WTI off of these plays we have, but just need the free cash flow to work with to deploy.
Well, if all the U.S. LNG export facilities that are already completed, and you got one more big one, Train 3 down in Corpus Christi for Cheniere is coming online as another 2 BCF a day here pretty soon. The LNG exports out of the U.S. could be 5 BCF a day higher per day in Q1 2025 than they were in Q1 2024, because in 2024, Freeport was shut down the whole quarter. So you add that up, that 5 BCF a day, that's a big deal. That's like 5% of our total gas supply going out as LNG exports. And you got an administration down here that's bullish as hell on that. They're going to be pushing it. And if that happens, all North American gas prices will go up. I just don't see, we've been in this $2, prison for a while down here, and it's just not logical. I mean, it's such a difference. It's the cheapest, cleanest fossil fuel on Earth, and we're blessed with it. We just need to start using it. I don't know if you've been following it, but right now, a lot of these Permian Basin companies are going to start installing their own power generation and just use the gas right out of the ground. I mean, they got a dehydrator or something, but they can generate their own power out there in the Permian and power supply, because they rely so much on wind and solar out in the West Texas is also kind of iffy. So you got more and more companies looking into that. And I think there's another layer of demand. And then you got the AI data center, stuff. Just every report I see, it goes higher. So it's going to be, I think 12 months from now, we could be looking at, $4 or $5 gas, I believe. I mean, just look at the U.S. strip. The strip for like the December 25 price is over $4 today, I think. So
Yeah,
I've heard
I think ours is
estimates as much as
350.
like 10 to 15 BCF in the next 3 years, and not including the
up,
LNG
down.
demand increase.
Well, if
Just
you
for
look
the
at
AI bot farms.
and then you just look at the LNG export facilities are going to ramp up. Like there's a chart. If you look at Antero Resources, they have a really good chart on all the things that are going to be approved once Trump takes off. There's like 3 or 4 big ones that are on hold by the Biden administration that are going to get approved, and those are going to come online in like 27, 28. So you go out to then, and there's a big. And I've talked to people at API, and they think that we should be ramping up to the global price of gas, which is more based on energy equivalent to oil than it is when you go over to Europe and Asia. So there's huge upside, and I just think the right price for gas is in the $4 to $5 range. I don't think it's in the $2 to $3 range. So we just gotten, because of all this associated gas coming out of the oil wells, that's what's really led to this depressed gas price in the U.S. for so long. And I think there's stuff happening that, if it all lines up, is going to drive demand for gas like way up. So we'll see. Anyway, over the last 5 years. I mean, several questions about why the stock price is down, and let's just wait to see what happens after the first year. I think the warrants expiring are going to be a big catalyst. I think that's a big deal. And then we get past this tax loss stuff, and we're going to record a pretty significant increase in production from third quarter to fourth quarter. That should draw some attention. And again, you're going to get a fresh reserve report at the end of the year. This will also be positive. I mean, if it shows that, you're going to have a present value. You showed that slide with the analysts you have covered. Do you know what like their average price target is for those 4 guys?
Oh, geez, average price target. I think we're probably in that 40 to 50 cent, 40 to 60 cent range is my guess. I haven't looked in the last few weeks.
They're probably the same guys that are submitting their price targets to First Call. And First Call's price target today is 45 cents Canadian per share.
Yeah,
so that's triple the current share price.
That would absolutely be the same range. And I would just say too, Dan, with like as far as this past year, I mean, it's been a multitude of things that have kind of hit us. And Cam already spoke to just the sector, right? But I think from our asset-based perspective, like we spent 35, almost 40% less capital year over year on drilling. and we're able to grow our production still by 3% year over year. You know,
Mhm.
we have a pretty resilient asset base, and I think it was a decision by us, you know, to instead of growing significantly, like the previous year, we grew 50% in 6 months just by the drill bit, and it wasn't rewarded necessarily in the market, and not many things were, but we were then producing a lot of flush barrels at $70, $73. So we made the decision to focus on debt reduction, and the stock performance. Some people didn't like that, some people did like that, and then you just couple that with lower oil prices in a market that's been hammered, and this is where we sit today. But from a balance sheet perspective and an asset base and oil well performance perspective, we think it's been a successful year. So we just need to continue to do what we do and control what we can control, and I think there's lots of room for growth going forward here, guys.
Yeah, and I remind our members all the time. I said I look really hard at small caps before I put them in our small cap growth portfolio, and we've seen a couple of them just recently. You never know when somebody's going to really notice it, and somebody's going to really start doing something. You look at Solaris Energy Infrastructure. They announced that they're going to get into this, installing power plants for people out in West Texas. The stock's up 200% in like a few months. Then the other one was Calibre. You guys may be familiar. That was a Canadian, but it's 100% now in Oklahoma. Yeah. But it announced 3 good wells. They did 1.5 mile laterals instead of 1 mile laterals. They used a different completion method that was designed by Schlumberger or somebody, and these wells came on much stronger than their type curves, and they're holding up. And somebody notices that, and then next thing you know, you got some fun, somebody with deep pockets starts accumulating the stock, and it can happen. So with small caps, yeah, you just can't time the market. But the thing is, find good companies like this, like ROK here, that are grossly undervalued based on my calculation, and you never know. Somebody will notice it, and we'll see what happens. But it looks good to me. All right, guys, I think that's good. I tell you, maybe after the first year, when you really decide on your, next year's drilling program or stuff, get down to Houston and, present to our group down here. I think it's really good when they start getting familiar with you and, trusting you more by presenting to them personally. I think that really helps. We've got a long relationship with Hemisphere and In Play, and we're up big on both of those stocks. So we've had some of our biggest gains on Canadian juniors, and I just want to remind all of our listeners of that too.
Yeah, sounds good, Dan. Yeah, we'll definitely get back down there. I know we presented there.
Hey, thanks for doing this, guy. Thanks, Cam. Thanks, Jared. Brian, we'll talk again soon, and I'm looking forward to your fourth quarter results when they come out. And we will be publishing an updated profile on this probably next week. I've assigned it to one of my MBAs here, and they're working it up now. So anyway, thanks a lot. And Sabrina, why don't you end it there, and we will send out the link to the recording this afternoon.